Philippines, you're starting to see them betting on that geopolitical leverage with the sovereignty intact, anchoring billions of foreign industrial capital, and use that to climb from the raw minerals to the process inputs to the higher value tech components. So if you're in the Philippines or if you even service the region, I think the industrial opportunity of Pax Silica is real, but a lot of it is going to be dominated by the entrance of large-scale manufacturing. But it's not just chips. It's everything that has to feed that zone. There's still the question that if you're trying to go towards the smaller board, what's the quantum of funding? Why is it necessary in order to go the public pathway as opposed to the typical private market VC PE sort of pathway? Is it a matter of trying to unlock liquidity, recycle capital for investors that are otherwise stuck? Is that not just trying to pawn it off on the retail investors? Two stories coming out of, say, Southeast Asia this week, and not really anybody connecting the dots on these. On one side, we have the Philippines, which unveiled the marker for one of the most ambitious industrial bets it has made in decades, and in the same breath, told the United States it would not be running the place. On the other side, we have Malaysia, which is proposing to rewrite the rules of how startups and early-stage companies can follow the pathway to going public, specifically the ladder of an introduction to the capital markets, an ability to unlock retail money for the first time, and it's the latest move in a region-wide push that almost no one is aggregating into a single story. Two countries, two big moves in the same week, and the contrast between them tells you something useful about how Southeast Asia is positioning for the next decade. Welcome back to Sea of Startups. Let's dig into it. So let me start with the Philippines and the Pax Silica story, because I do believe it's a big story. So quick backgrounder on it. Pax Silica is a US-led alliance launched back in December of 2025, and the pitch is simple. China dominates critical minerals and chip manufacturing, and the U.S. wants an allied supply chain that doesn't depend on China, playing the geopolitical angle that we are all very well familiar with. And the Philippines joined in mid-April of this year, and the idea is that they will contribute about 4,000 acres in an economic security zone in New Clark City, which is about 2 hours north of Manila. It's been designated as the first AI native industrial acceleration hub under the Pax Silica framework, or what the State Department is calling a golden node. Lots to unpack on that golden node, but we'll go on with the story. So this past Monday, the 18th, I believe, of May, U.S. Undersecretary of State for Economic Affairs, Jacob Helberg, flew in for a site visit. He unveiled the marker. More than 20 companies have already expressed interest. A dozen of them are multi-billion-dollar U.S. companies. There's at least 5 U.S. and East Asian firms that have specifically indicated they want to locate inside the zone, and that interest is spanning robotics, electronics manufacturing, AI training infrastructure, power generation, renewable energy, and water management. Of course, if you're going to have this big of an economic zone focused on manufacturing, you definitely need the power generation, renewable energy, and the water management in order to sustain all of that infrastructure. Technical site assessments are going to begin in June, so in not too distant future, but the actual groundbreaking, because these things take a lot of time, is targeted before the end of 2028. So a lot could still happen between now and then, but that's the headline. But here's the part where a lot of the press is not covering, and I want to spend a little bit of time on, is that while we talked about the initial proposal was that the hub would operate under U.S. laws and that U.S. personnel would essentially enjoy a diplomatic immunity. There were a lot of raised eyebrows globally as well as in Manila. It sounded like a value chain rental, not a gain for the local ecosystem, where the Philippines provides land, minerals, and workforce, and essentially the Americans bring capital and write the rule book. But in this week, I believe just the other day or perhaps Monday, standing next to Helberg at the site unveiling, the BCDA president Joshua Bincang publicly killed that framing. The Philippines, he said, had rejected U.S. requests for diplomatic immunity and U.S. legal jurisdiction. The hub will continue to operate under Philippine law, specifically an Investors Lease Act, which was recently amended to allow foreign investors to lease land for up to 99 years. And that law, which also governs the conversion of former U.S. military bases, it will be treated as a regular business development contract. The Undersecretary of Trade reinforced it, and the framework would be based on Philippine laws. That's a meaningful moment in this conversation as well, because it's the country drawing a line on what kind of partnership this actually is. And Manila saying, hey, we will partner with you. We will host you. We will give you at least grace period, even as goodwill contribution, but you don't get to govern the zone. This is our sovereign territory. It's our own sovereign jurisdiction. We do. So that changes the read. This is not necessarily, this is no longer just a U.S. governed enclave within the Philippines that puts their flag on it. This is a Philippine economic zone with a U.S. led anchor tenant. So they also went on to say that the Philippines, as part of this, wants to move beyond simply exporting raw green minerals like nickel and copper, and instead start processing them into the higher value green tech metals used in batteries, data centers, semiconductors, and electronic components. And so this is not just another platform. This is an opportunity to climb the value chain. And that's the essential industrial policy that seems to be attached to this, is get out of things like the raw materials lane and move into the processed inputs as well, trying to get some of the knowledge transfer in the other industries and start climbing the value chain in other areas like semiconductors and the rest. And so the country, Philippines, is bringing real assets to this potential deal. The Philippines is already the 9th largest semiconductor exporter in the world. Electronics products were nearly $40 billion in exports last year. And it accounted for a major part of their exports, around 60% of exports. The industry of semiconductor goes back a long way. There's roughly 40 years of OSAT experience. You have players like Amcor, Onsemi, Analog Devices, Texas Instrument. They've all been operating in the Philippines for decades. Philippines has massive nickel reserves. They have an English language technical workforce. That trajectory is positive. And now you're starting to see a lot more countries gathering on into the same arrangement, the Luzon Economic Corridor. Now, in the same breath, you also had the Philippines, which had previously published its first semiconductor roadmap last year, where it was targeting $110 billion in combined semiconductor and electronics exports by 2030, to see a near tripling of that sum. The country is making moves. The combination of Pax Silica with the sovereignty intact, the Luzon Economic Corridor expansion, the semiconductor roadmap, that is a great start. It's a coordinated industrial push by the Philippines, and really the first thing in my recent memory that I have been watching. So something to watch out for, something that hopefully will have residual impacts and provide opportunities. So let's put this into context in regards to what else is going on within the region, because every country in Southeast Asia is also running some version of this play. Semiconductor manufacturing, climbing the value chain, and the differences matter. The approach, the impact that it's going to have to their ecosystems. So on the one end of the spectrum, you have Singapore, which is in a category of one in the region. They produce 10% of the world's semiconductors. I believe they produce 20% of the equipment as well, and they cover the full value chain. So it's not the lower end as you see elsewhere. In They actually are already in IC design, fabrication, advanced packaging, testing. Um, you saw companies like Micron recently broke ground on a 24 billion US dollar wafer fab. Operations expected in a couple of years. You also saw another 7 billion HBM advanced packaging facility started last year. UMC opened a 22 nano fab in 2025. Singapore government is putting massive amounts of money into a shared national fabrication facility that startups and SMEs will be able to access by next year, with an initial focus on advanced packaging as well. So there's a lot going on in Singapore where they're already in the high end, but they're doubling down. And certainly the idea of compute and chip design and chip manufacturing, its importance and relevance to global supply chains, and the strategic importance is definitely at play there. Now, near neighbor to Singapore is Malaysia, which is the sixth largest semiconductor exporter in the world, and they are about 13% from the statistics that I looked up in regards to a global assembly, testing, and packaging market. At the end of last year, you saw a bunch of companies come together to form the Malaysia Advanced Packaging Consortium. And then a couple of weeks ago, you saw Semicon Southeast Asia 2026, where they signed a formal MOU with the Ministry of Investment, Trade and Industry. Malaysia's putting up grant money. Industry players are matching it. There's a target of growing the advanced packaging market. And then you also saw Skychip just recently have their IPO. That's one of the first examples of climbing the value chain within Malaysia. And you're starting to see much more traction in regards to them setting up IC design, starting to see more of the higher value components starting to enter and build into Malaysia. So another meaningful movement within that space within the region. Now, on the other side of the spectrum, you also have Vietnam, which has also started its own construction of its first homegrown semiconductor fab back in January, led by state-owned Vietel Group. Pilot production is anticipated to start next year. And then last month, Samsung also committed over $1 billion um, for a facility that is essentially going to supply Grok's latest LPU chip. NVIDIA separately signed government-level partnership for R&D. Qualcomm built a major AI R&D center there. You're starting to see more emphasis on the talent end of the spectrum. When it comes to talent development, Vietnam has been absolutely phenomenal of climbing the stack and is one of the sources of technical talent, as they've emphasized very well on the educational front. So what you can see is that each country is betting on this industrial side as a strategic positioning as we start moving into the era where compute becomes more and more important, and having touch points on the industrial side, on the hardware side, becomes more and more relevant to it. So Singapore is betting on its ecosystem, decades of stack capability. Malaysia is betting on its operators, the returning diaspora founders, and the government co-investment and sponsored programs. Vietnam is betting on that talent, plus anchored multinationals, train the engineers, attract the giants, let domestic capability grow. And now with this recent deal in the Philippines, you're starting to see them betting on that geopolitical leverage with the sovereignty intact, anchoring billions of foreign industrial capital, and use that to climb from the raw minerals to the process inputs to the higher value tech components. Different theses, none of them wrong, shaped by the competitive advantages of each market. So definitely something to continue to keep our eyes on as that plays out. Let me tell you about our friends at Your CFO, the financial planning system for your B2B startup's growth. Running a business is hard enough. You're focused on product, you're focused on sales. You don't have time to hire your own CFO or maybe even your own bookkeepers, and your CFO is here to help. Building your forecast is easy as 1, 2, 3. You set your business as usual case, then you set up what your growth initiatives are going to be, whether it's launching new products, hiring plans, market expansion, and put those all together and generate your final forecast. And with your projection set, you can run variance analysis, stay ahead of any shortcoming or overachievement so that you can adjust in real time. Need to look forward? You can build out your rolling forecast. As the actuals update, you have new and improved forecasts. Have fundraising plans in the future? Build out your forecasted cap table. Understand what metrics you need to hit those valuation targets. And last but not least, all those board reports, investor reports, fundraising, financial projections, all exportable, all buildable, all in one place. So go to yourcfo.tech. That's yourcfo.tech to get started today and make an impact on your business. Now, there's a very getting into the second story, there's a parallel race amongst the markets within Southeast Asia that's going on in the capital markets, and more specifically, talking about the public markets. Each country trying to fix essentially the same problem with a little bit of nuance for each. And the aspect is that the public markets for venture-backed and emerging companies has been broken, or one would say even non-existent in the reality of it. The IPO window has collapsed, SGX listings thinned. Malaysia has had a number, but there's certain question marks there. Indonesia had a big fervor, but that's kind of thinned out given the number of issues that have gone in that market, the indices giving them some pushback as well. And you're starting to see regulators responding. You're starting to see government initiatives in order to try and resolve this. So not surprisingly, to go country by country, we would see Singapore kind of leading the pack with the most aggressive strategy. So if you flash back a couple of years, the Monetary Authority of Singapore set up an equities market review group to try and figure out what they should be doing. And that package was huge. They started off with tax rebates, 20% on primary listings, 10% on secondary listings. They put billions into equity market development programs, which has since been expanded to even to more billions. They've selected specific asset managers that they could use in order to help deploy and even developed a value unlock package to help listed companies improve investor engagement. And a very big move, which we covered on this podcast before, happened at the end of last year, which was when SGX signed a partnership with NASDAQ to launch a global listing board for dual listing, something that would be more seamless than the historic depository receipt scheme that many foreign listings or dual listings end up following. That framework is supposed to be going live soon. From my understanding, there's quite a few companies that are queued up and talking about following that pathway. It's the first formal dual listing partnership that NASDAQ has ever done. So it doesn't seem like Singapore is necessarily trying to solve the small company problem per se. They're trying to find a pathway so that the giants, the premium names, don't necessarily have to leave the region per se, but can still end up being anchored in both markets, attached to the liquidity of overseas, while still being able to get the analyst coverage and the investment banks paying attention while the listing is here, and leveraging on that content angle from the domestic market, the liquidity from the foreign market, and playing that angle. Still TBD in regards to how that will play out, but they're definitely seeming to lead the pack presently. Thailand has been quietly building as well. They've done a handful of moves. They're definitely still early in their efforts to be doing it. They have a live exchange for SMEs and startups, which they launched years ago, but it's not really very effective. They did a depository receipt linkage with SGX a few years ago so that Thai investors could access Singapore listed. Handful of measures, not super effective as of yet. There's a lot of conversation about things in the pipeline, so we'll watch out for that. Not sufficient enough content to be digging into as of yet, but hopefully we can reverse back to that at a later date. Coming into the opposite end of the spectrum, where Indonesia was a little too, let's call it loosey-goosey with the way things were going, at least from my perspective. Indices have started pushing back in regards to the free float. You saw a rush of IPOs from their domestic market, many of which were held up as championing the local startup ecosystem. A number of the quote unquote unicorns of at least that were unicorns at that time period ended up going public. You saw a number of retail engagement, but that's kind of fallen off along with it. And what you see now is IDX essentially saying that they want better quality listings, not necessarily more listings, and they're tightening up at home, although they seem to be opening cross-border access at the same time. On the topic of cross-border access, as some of you may know, there were MOUs signed a while back about cross-border flows and being able to more easily facilitate depository receipts amongst the ASEAN 6. But then let's go into the actual story, which was talking about Malaysia and a proposal from the Securities Commission Malaysia, as well as Bursa Malaysia, the exchange, which they released a public consultation paper proposing several big changes, some of which I have some question marks on, but certainly some things that seem quite positive. Now, most of it is focused on the LEAP market, which is the stock exchange for early stage and emerging companies. Essentially, if you think about the capital market ladder, LEAP market would be at the bottom of it. Then you go into ACE market, which is your next level up. And then you come into the main board, which is where you ultimately try and graduate up to. So it's been around for years, Leap. It hasn't really worked very well. I think at least from what I was looking, only one company transferred from regulated equity crowdfunding into Leap, and then very few Leap listed companies actually graduated into the ACE market. And so it hasn't really been effective in regards to being able to get that ladder. And so part of it is a question of, is it just not being able to attract the best listings in the first place? So is it a sourcing question, or is there a survivorship question in regards to being able to follow that pathway? So I have not dug into the details of every single company and Leap, so I don't have the answers for any of that, nor do I have opinions on that specifically at this point, but certainly questions that I'm sure are ruminating amongst the back rooms over at these regulators. But here's a couple of interesting things that they're proposing. So first off, barriers to entry of public listings are high. And that's one of the key things of why you see the stay private longer in Western markets as well. And so what they're proposing here is essentially allowing the VC and private equity firms that are invested into these companies to act as listing agents. So if you have already raised, I believe 5 million ringgit, which is about 1.25 million USD, from a regular crowdfunding platform, or if you have a VC or PE firm on your cap table, you can list on Leap without having to appoint a traditional approved advisor and deal with the costs associated with that. Your VC sponsors you to the public market, essentially, and that collapses that traditional banker-led IPO economics. The other interesting aspect on this is retail participation. And so historically, retail has been excluded from being able to participate. But here, what we have is they're essentially allowing them to come in, but with caps. And so it seems like from it that there's a 250,000 ringgit total exposure cap. This seems to be the first time that an exchange is focusing in this way. The question that I did actually come back to, and maybe there's details that I didn't get off in first read, so somebody correct me if I'm wrong on this, but if this is the focus of saying, hey, we need more retail participation, and this is the trigger since institutions may not be coming into these early companies, how is this retail participation dramatically different than ECF? Is there qualifications that I'm not aware of that is segmenting who has access to ECF that is then going to end up moving, say, further downstream within the retail base? Or how does this actually dramatically change relative to the pathways that already exist for retail investors, angel investors, etc., to be able to actually access? Is this simply changing the definitions of the accredited or qualified investor definition so that, as I said before, simply being able to go further downstream in regards to the economic stratus? So that's questions to still digest at this point. Again, it's simply consultation to try and gather more information from the ecosystem. Some of the other things that were in here, which is on the positive side, is simplified disclosure documents. Now, certainly a balance, because what we've seen around the region is problems with disclosure. This has been, unfortunately, a bad last couple of months or years with some problematic startup occurrences, specifically some of the stories that we've covered. But by going lighter on the documentation, especially with some of the onerous requirements that go with public listings, we do have an understanding that this is geared towards trying to drive down the legal costs and those administrative frictions that are associated with it. Another aspect, keeping on the same sort of cash burden to the startup in regards to listing, is now advisors are able to take up to half of their fees in association with the work that they're doing on the listings. They can take up to half of their fees in shares. So that should end up having an impact in regard to the cost burden for going through listings as well. Another thing that was listed on there, again, this kind of goes to the pathway of graduating from one tier to the next, is there's discussion and there's aspects that are related to streamlining the transfer from Leap to Ace Market, sort of that bottom tier to the next tier up, and really kind of looking at this from the standpoint of the funding escalator, and specifically trying to design it so that venture-backed companies that are too small for mainboard or perhaps even for ACE have pathways in. Now, mind you, there's still the question that if you're trying to go towards the smaller board, what's the quantum of funding? Why is it necessary in order to go the public pathway as opposed to the typical private market VC PE sort of pathway? Is it a matter of trying to unlock liquidity, recycle capital for investors that are otherwise stuck? Is that not just trying to pawn it off on the retail investors? Lots of questions still. I'm generally positive on trying to make each component of the capital stack, but I think with all of this, it's a matter of not necessarily what the intention is, but whether or not when we think about the current status of where we are in the capital market development, of whether or not this well-intended effort is going to actually have the intended results, because that is not always the case. And we do have to keep that in mind, that if you try and do step 3 before you've done step 1 and 2, even if it was correct, if you were on step 3, if you do it too early, too soon, it may end up not having the desired impact. So something to keep some attention to there. And so I think overall, the connecting of the dots is that when you zoom out, what's happening in Southeast Asia is really 2 simultaneous races. That first race is the industrial side of things. It's getting into the changes of supply chain, specifically in this case, talking about the digital economy and the industrial and hardware segments that are going to end up being required in order to support it. Different bets, different segments. So certainly something to keep an eye on as those develop. Not efforts that end up happening overnight, but certainly something that I think is notable and worth keeping on everyone's radar. Second race is capital markets. The dual listing bridge, Leap Market 2.0, Indonesia's tightening, the ASEAN depository receipts framework. Lots going on here. I remain cautiously skeptic in regards to the viability of the IPO pathway and whether or not the public markets will actually end up becoming the high probability or the desired, primary desired outcome. And so something to watch. Hopefully it ends up moving there. Again, I'm generally positive on the efforts of having a robust capital stack. It's just a matter of whether or not the phasing is going to end up leading to the desired results. Both races are happening at the same time, and they do kind of reinforce each other, because you can't really have a real semiconductor and AI economy without the functioning capital markets behind it, so that you can see the pathway of fundraising, the ability to see capital recycle back into the next generation of founders. Singapore has already started doing that. There's still some flaws inside of the ecosystem, but certainly interesting there. I think with the news story on coming out on Pax Silica, the Philippines is running hard on the industrial race. The country has put together a very ambitious move, and the most ambitious that I've seen, and it's quite impressive. On the capital market side, Philippines itself is quite quiet, but you've seen a lot of moves coming throughout. Something to watch there in Malaysia. So, couple of takeaways that I would wrap this up with is that on the industrial base side, so if you're in the Philippines or if you even service the region, I think the industrial opportunity of Pax Silica is real, but a lot of it is going to be dominated by the entrance of large scale manufacturing. But it's not just chips. It's everything that has to feed that zone. So when you think about the entrance of all of this manufacturing base, founders and investors, we need to be thinking about all of the industrial automation software, the predictive maintenance for factory equipment, workforce training platforms to upskill thousands of engineers, mineral traceability software, because the crucial minerals coming out of the mines need chain of custody verification. We need energy management software. We need logistics platforms. We need customs platforms, ESG reporting tools, supply chain visibility software. We're just scratching the surface in regards to what the potential opportunity is. And I think the general shift of supply chains are benefiting the region. And this is just another example that is adding to that momentum within the region. And I think now is the time for all of that. So we don't necessarily need to be looking at the immediacy of climbing that value chain, but all of that supporting infrastructure, I think, is capable to be built and serviced by local or regional founders. And some of the most valuable companies in semiconductor economies are actually not the chip companies. They're in the related industries. So we do have that. On the flip side, Malaysian founders, policy environment does seem to be trying to figure out ways that they can improve the ecosystem, pathways for funding, escalator in order to get into the public markets. More to come out. We'll see what actually ends up coming out with. So for founders anywhere else in the region, the capital markets are being rebuilt. Each country is solving for different segments. Pay attention to which segment it fits for your company and your geography, and keep on building. So here's where I'm landing. 2 stories, 2 races, both real, both ongoing. Keep on watching it. Southeast Asia is doing something it hasn't really done before. It's simultaneously advancing and building its industrial base for the AI economy, and trying to position its capital markets for venture-backed companies all at the same time. Each country making different bets. Some bets will work, some won't. That's fine. Me personally, I'm very bullish on the Philippines. The fundamentals are real. The trajectory is good. I think Pax Silica is an interesting bet for the moment, and the way that Manila is handling the sovereignty question shows that it's not just going to be a passive host for the steel. The next move that matters is the capital markets one. I think foreign industrial capital is going to come in under Philippine law. I think domestic founders are going to be building the picks and shovels companies that feed it. But ultimately, every startup, every invested company needs real pathways to liquidity that gets them to compound wealth, recycle it into the next generation. That gap exists. Closing it is the work of the next couple of years. If you're an investor in Southeast Asia, I think the question that everyone needs to think about is each country is making different bets. Where do you think capital compounds best? Because that tells you where to deploy. I have my answer. We've got our priority markets. And so I'd love to hear yours. If this story has hit with you, please share it with somebody who needs to hear it. If some of the ideas did not necessarily resonate, or if you have some pushback, reach out to me. Love to have a conversation. That's the show for today. This is Sea of Startups, real, raw, relatable. That's the deal. We'll see you next week. Bye-bye. And that does it for this episode of Sea of Startups. If you've enjoyed what you've been listening to, please give it a like, give it a review, subscribe to our channel. A little bit of feedback goes a long way in allowing us to keep on putting out these kind of episodes.